we're going to be diving deep into cost segregation studies, all things cost seg. So would
Yeah.
love if you could give us just a high level overview for those who are not familiar. What is a cost segregation study?
Yeah. So the government allows people who buy investment property to depreciate that property. Depreciation is really just an understanding that stuff there's wear and tear, and because real estate is heterogeneous, or in other words, is every house is different or every building is different. They don't have a good way to understand how you would depreciate it. So they set a general rule: 39 years for commercial, 27 and a half for residential and multifamily. And that's, really just kind of like an admission that they're just going, listen, we don't know how this is. So,
So you figure it out.
well, yeah. So you figure it out. Well, that is, what they would call the composite method. And then, but they did, through different case laws and everything, they decided that you could break up a piece of real estate into its individual components because they do run out at different times. However, you have to have a professional who knows what they're doing, right? So as a property owner, you don't have an inherent skill to, identify, quantify, and cost every piece of like commercial or construction that's in your building.
Right.
And so what we do is we come in and we, like we were just saying, is we scan the property. We identify all the different components, from carpet to plumbing to electrical, roof, site improvement. And then we break those out. And then we use the different case law that allows us to break those out into different depreciation schedules. So 5, 7, 15. And then the remaining, like, structure, remains in 27 half or 39. That allows to kind of push that forward. So if you would understand it this way, is in year one, you would have all of the 27, all of the 15, all of the 7, and all the 5. In year two, you have the same, but in year 6, you've used all the 5. So you have only 7, 15, 27. And then in year 16, you only have 27 left. So that accelerates the depreciation towards the front end. And then with the new tax laws, anything under 20 years, you can bonus depreciate. So you can take all in 1 year. So anything that is 15, 7, 5, and below, can be depreciated all in the first year. And then you just depreciate the remaining 27 years for the rest.
Got it. So just in full disclosure and transparency, Scott, you've done several cost segregation studies for me, and that explains why that number was so big on the front end of year one depreciation, was because of this bonus depreciation you just mentioned, right?
Yeah, that's right. Yeah. So a lot of people, I mean, it depends on what your goals are. We've always said our goal is never to give you the largest depreciation. Our goal takes a step back, and we want to give you the largest tax deduction for the longest number of years, right? And that's important because sometimes bonus is good for you, and sometimes it's not, right? So if you had $180,000 you want to write off, but you have a bonus of 1.2 million, you don't lose that bonus, but you have to carry it forward. And the problem with having to carry it forward is, if your next year of income happens to be 20,000, you use that 20,000, you'll carry forward your deduction, but you're not writing off. Those are low tax dollars. I would much rather see you, instead of having 1.2 million, go, hey, we're going to take, so your income's 180, we want to write off 170, but then have that 170 every year for a number of years. Because then every year, so the number of years you have, you're all knocking off that top end 40% tax rate, and instead of using it on the 10%.
Got it. And so if I heard you right, there's the year breakdown is 5, 7, 15, and 27 and a half. But did you say that there's some things that are depreciable for a shorter lifespan? Or did I
There are.
mishear?
They don't typically. So There's an IRS document that says how to depreciate property, and there are some individual items that they put out there that are different. We actually just did one on a Native American land, which was interesting. All of the, the fives go to 3, the 15s go to 9, and then the 39 goes to 22. It's strange, but
okay.
But yeah, so just, but there's just different ways to depreciate different property. So a lot of that doesn't apply to actual real estate.
Got it. Okay. So the big categories we need to be aware of are 5, 7, 15, and 27 and a half.
Yeah.
Okay.
That's pretty much where it falls.
Okay. And so how does it work? Like if I've got this house, right? Let's say I bought it for 200,000. Is the cost segregation based on the purchase price? Is it based on the taxable value? And then how do you know how much electrical is in that house versus how much plumbing versus how much drywall?
Sure. Yeah. So the nice thing with us is that we actually don't go off of valuation. We go off of cost basis. So we go off of what you actually paid or what you actually put in the property. So for us, that's maybe not be a benefit for some people because like they go, hey, the value's way up. But for us, it makes it a lot easier because then we're not having to make a judgment or say, hey, I think my property is worth $1 million. We go, well, that doesn't really have anything to do with it. You bought it for $500,000. So that's what we're working with. So it's very simple in that way is that, I bought it for $500,000. I put 100,000 in, and those are the numbers that we work with. Right.
Okay.
So, and then how we do it is, this kind of gets into why, some of the people have never heard of it or why their CPA never brought it up is because we work with construction, right? We work with construction engineers. And so part of our process is, scanning, identifying, and measuring, all the different components. So start with the easy stuff, right? The stuff that you can physically see, right? So we actually create floor plans, and we have something that's really cool and very helpful called a ceiling plan. So imagine you have an office that is 20,000 square feet with 200 offices, right?
Okay.
Try counting the fluorescent lights in that.
I'd rather not.
Right. I mean, and here's where the trouble kind of comes in is you go, okay, so I'm standing in this office. Now try to picture it. I'm standing in an office with 200 rooms and 20,000 square feet. I mean, I don't know if that's accurate or not, but whatever.
Yeah.
And you have to count anywhere between 120 and 130 different items. So do you count just like the fluorescent lights and circle the entire building once? Or do you count all of those items that's in the room and then go room by room counting, 50 to 100 items? All those things. So it becomes very, very difficult. And so that's where our scanning comes in is, so like it actually looks upwards at the ceiling because we've scanned the whole thing. And so on one sheet of paper, I can actually just see every single light in the entire thing. It also helps us see one of the tricks that we have is if you can see like a floor plan, but that looks at the ceiling, you can see where all the vents are. And HVAC will run the length of the building and will branch off of a main pipe. And so we can actually draw the HVAC from that plan. So that's, kind of one of the ways that, we're able to kind of fix things and identify them. There's other little tricks of the trade that we don't want to give everything away, but for the most part, we can see, see everything. I know you do multifamily. There are large multifamilies here in Arizona that, they're 200 doors or something like that. One of the difficult things is there's usually about 50, 200 square foot squares of gravel that are throughout the entire property.
Okay.
And when you're not looking down like a satellite, that's almost impossible to count. I mean, like I think about this all the time, and how we can, work with other competitors, and I'm going, there's no way, standing on the ground and actually counting and measuring, because, frankly, a lot of these shapes are not squares. They're, different shapes. So, without a computer, how would you get the square footage of these little tiny bits of gravel all over a place?
Mm-hmm.
And I think the answer is I don't, right? So what happens is that with a lot of cost segregation companies is you'll get a cost allocation. So they'll say there's, $100,000 of gravel on this whole big lot, but there won't be a quantity allocation, right? So they're not actually measuring it and then multiplying it by square footage. They're just going to the end and getting an estimate.
And why does that matter?
Everything has to do with accuracy, and so the IRS puts out guidance, and they actually name several levels of cost segregation. The highest level being actual cost and engineer base. So you go out and measure everything. Count everything with the actual costs, and then the next best is the engineer base with estimated cost, which is we do a combination of those two items mostly. And a lot of times, if you just built or you remodeled, you actually have the actual cost.
Right.
But if you bought a property, you paid a price. So many times you don't have any idea what your actual costs are going to be. And so estimate is the next. But then it kind of goes down from there. And so then you kind of fall into rule of thumb, which is essentially what that is, based on a property that's this expensive, a rule of thumb would be, 30%. And I'll explain it this way. And this is kind of like a financial valuation, but there's a rule of thumb in like companies that if you ran a company, you would pay 2 to 3 times revenue. Right?
To purchase that company.
Yeah, to purchase that company is, if they made $1 million of revenue, you would buy for about 3 million. Okay. Now, the two of these companies each do $1 million in revenue, but one has a 85% profit margin, the other one has a 15% profit margin. Right? Are those two companies valued at the same?
No, they shouldn't be.
They should not be, right? So your rule of thumb is helpful, right? It is a good starting point, that you would pay 3 million. But if you paid $3 million and your profit margin was 15 versus paying 3 million for a profit margin of 85, one person got ripped off.
Yeah.
And,
yeah.
And so what we've always said is, you're getting what you're paying for. And I think the issue would be is if you're paying for an engineered base study that's at the highest level because you would like to have some level of audit protection, you're paying for that, but you're not getting it, then you're getting ripped off.
Yeah.
And I'm not trying to accuse anybody of ripping people off, but you have to deliver what you say you're giving, and that's where we, I think we shine is we're very clearly able to deliver it, and not only that, we can deliver your property to the IRS if need be. We can just send them the walkthroughs and the 3D models that we have. And if they want to count the trees, they can count the trees. If they want to measure the drywall, measure the drywall. They could actually do that. And that's, I think the difference that we bring versus other people.
So if somebody was going to go get a cost segregation study done and they were interviewing a bunch of different companies, much like I did, how would somebody ensure that they're getting the most, bulletproof study result that they could? What questions should they be asking?
Yeah, I think the first question is an engineer based, right? That is, what the IRS is mostly looking for. There's and this question would bound to come up to for most people is when you're searching, you will find the DIY. Um, and I mean that in a general sense, right? Like do it yourself kind of thing.
Mm-hmm.
Um, uh, but what you would do with those is you send in where your address is, maybe a few items like roof type and a thing like that, and then they send you back within a few minutes your allocation, right?
The breakdown
So
of your 5, 7, 15, 27.
yeah, breakdown 5, 7, 15. So that would be really a rule of thumb or an estimate, right?
Sure.
And then what they add is kind of an audit insurance, and that is an interesting to cover because when you read the fine print on that, what that means is that if you were ever audited, then they would actually come out and do an actual cost seg.
Playing catch up.
Yeah, but I go, that's not how that works, right? So let's think about our tax system, right? Our tax system is an honor system, so they're expecting you to do your taxes correctly, right? That's the expectation of the honor system. Once you've been audited, you don't get to go to them and be like, oh, whoops, I meant to not take that deduction that I didn't really do, right? It's too late at that time. You don't get to change the numbers. The numbers are what they are. You submitted them and you signed off of them as they are true.
Sure.
Okay. So even if they did come out and do a cost seg, what are they going to do? Perfectly match them to the estimate that they gave you? I mean, that's the thing that I just don't really understand is they going, hey, yeah, we it's kind of like back in, you probably remember back in the mortgage days, it's like guy selling a house. He's like, dude, I need this appraisal to be 300,000.
Right. Make it so.
And then the appraiser comes in and be like, hey, it hit 300,000. What do you know?
What do you know? Yeah.
What do you know? And not trying to degrade anybody who might have been in that industry. I mean, that there's a whole system starting from the financial side down that that messed everything up, and the whole thing was messed up. So don't want to attack any one person or industry in that time, but facts.
It happened, right? Yeah, that's how it went down. Okay,
it did, yeah. So those, and that's the thing is like, so I just don't really understand how that, how audit, how audit insurance, would even work. And so, I always, we kind of make a joke about it. We're like, listen, if you want to, take your $500 and say, I took a couple bags down to Goodwill and, that's my charitable donation. I get $500. A lot of times you're not going to need a receipt for that. But the area that we deal in is we're gonna give you a $1.5 million tax deduction. So you
have a good receipt.
Hold on to that receipt. It's like Dumb and Dumber, right? This $250,000 I owe you. You might want to hold on to that one.
Such good
That's
reference.
as good as gold, guys.
Right.
Yeah, I know, right?
So, that's awesome.
So we just go, listen, we're gonna document. We're gonna give you everything that any other company give you from the exact numbers, but then we're gonna give you you have access to 608 4K photos, 3D models, and a 3D walkthrough of the property. And I don't know if you wanted to go to a different topic, but one of the interesting things about the doing a walkthrough versus a photo is very, I think it's actually really interesting. And how that is if I were to say that I had, 40 fluorescent lights, and my proof that I had fluorescent lights was a picture of a fluorescent light, right? There's no context there.
Right.
I mean, I could take a picture of my fluorescent light right here and say, hey, there's a fluorescent light.
There's 40 of these.
There's 40 of them, right?
Yeah.
When you can physically walk from room to room in a virtual walkthrough, hey, I'm in this room, there's 4 lights. And then I walked out of this room and walked into the next one. There's 4 there. So you can actually count them and know that you didn't miss anything. So
that makes so much sense.
Yeah.
And I love the 3D model too, because I took this statistics course in college, and the first day the professor handed out like a thing. It was a cylinder and said, okay, I want everyone to measure it and come write down what your measurement is. And everybody, of course, had a different measurement. And the variance between, the whole class was massive. And it's like, we all have the same measurement stick. We're all measuring the same device, but yet the disparity is huge. So I could definitely see that with someone walking through and measuring versus a walkthrough tour where everything is modeled out. We're all looking at the same thing.
Sure. Well, and I think too, I mean, dive right into it. Let's look at the economics of it, right? One of the reasons people didn't know about cost segregation studies is they used to cost $30,000. And so you had to, in order to make it economical, you had to own a $10 million building, right? Because, you better get a massive write-off and have a lot of profit to pay 30 grand.
Right.
Well, now those prices have come down and they've really, they've pushed down to the, I don't think we do many under 9. I mean, there's always massive buildings that are complicated, but it's more in the 3 to 6 to 7 ish range. And what the question is that how have the costs changed? And we think about this constantly, and the best part is we're super transparent. We've cut costs with technology. We don't have to send a construction engineer to your property. We can have a pilot operator go to the property, scan it, and then we can have our engineers working from a computer. So it's a lot more efficient. And so we can cut costs because we've added tech. And we go, how have you cut cost? Right? So we look at those things and we go, you're supposed to be sending, all the other companies, or you're supposed to be sending an engineer out. And you go, right, but you used to make $10,000. Now you make 3 or 4, right? Okay, so what's cut?
Right. What are you doing differently?
And we have some guesses. We think that the amount of time spent on a property is being cut. And we have some examples of that. I don't want to be too accusatory, but we know how we do it.
Right.
We use technology. And we use efficiency, and that's why how you're still able to get the top quality, and with the prices coming down.
Right.
And and that's I'm sure a question that most people are going to want to know is how is pricing set and how much do these things cost?
Right. So let's talk about that, and then we'll jump into who these are good and bad for. So
sure.
Is there kind of a ballpark estimator? If I've got a $500,000 property, a cost seg might cost me this much, or how do you determine price?
Yeah. So I actually wrote a program that you can run a quote on our website. So it's rcgvaluation.com, and then you just click the quote button. It's absolutely free, and most importantly, we had a lot of debate about this. You don't have to give us your information to run the quote.
Awesome. I don't have to give you my social and a credit card and my email address, all that stuff.
You don't have to give us anything. You can just sit and run quotes all day, and it's free. You can you can make adjustments and see how the variables work, because that will adjust the price.
Okay.
And excuse me. And so it'll adjust the price, and how much you can depreciate. So the different types of properties. So there's a few variables that kind of go into it. I mean, basically, it's pretty simple. If it's more expensive and more complicated, the cost goes up. If it's smaller and simpler, the cost goes down. But the number one discount that we give people is doing multiple properties. So if you're running a quote on our system and you go, hey, I own 10 properties, but I'm only looking at cost seg for this one. You can run several quotes and add that multiple properties thing up, and you'll watch your price, drastically get cut. So it's an incentive to do more business with us, which we're, again, pretty transparent about. We want you to do lots and lots of business with us, and maybe that's just kind of my background, but how do you incentivize someone to do more business financially?
Right.
Yeah.
Okay, your cost is going to go down if you do more. So.
Okay. So most of our listeners are in the single family space. I would argue in the $150,000 purchase price.
Sure.
So let's talk about who are good candidates to have a cost segregation study done? If I said that verbally correctly, who would benefit
Yeah.
from a cost seg study,
Who would
and
benefit? Yeah,
and who wouldn't? Who should avoid these?
absolutely. So let's just start with the who wouldn't, because that is probably a lot easier, and more narrow, and then you can just kind of balance yourself out. First of all, most flippers just don't fit.
Okay,
And the reason is pretty simple. You want a very, very high cost basis when you sell a property because you
right,
don't want to pay a lot of taxes.
right, on that gain.
We give people very low cost basis. So it just doesn't, it doesn't fit. We would like to see probably a 5-year hold. Some people say 3. Not super comfortable with that. I would like to see over 5 years. And there's reasons that we can get into of why that is, but the cost can be prohibitive, right? Because what happens is when you get to a low enough number, we hit like a fixed cost, right? So
Sure.
even for a pilot to go out, it's just like, listen, it's going to cost X plus time, right? So
Right.
if the time isn't that great, it still costs X. So, there are some hard floors that we hit that we try to do, but, and that's kind of where, but if you'll see in our quoting system, uh, it is designed to make it cost effective, right? So it really is just kind of a ratio. So you go, well, I own this property, it's 100,000. Is it worth it? You go, what'd you pay for it? Right? If you paid nothing for it, then yeah. If you paid, you know, $7 grand for it, then no. So you have to understand what your costs are. Also, you're going to have to understand what your tax year is going to be like. We see a lot of times we see some people that it might cost a little more, but they had a major windfall and they just don't have any other way of reducing their taxes. So, give you an example: somebody that is trying to 1031 a property. Say they bought a property, 200,000. They're selling it for 2 million, and it's they're trying to get the 1031 through, and it's November, and it falls through, right? So now you got $1.8 million of gain, and you owe capital gains on that. So I don't know, what is that, 400,000 ish,
It's a
whatever.
crap ton.
It's a lot. And let's just say that you don't have 400,000 in cash, or whatever. I don't know. In that scenario, having $100,000 house, and then you do a cost seg that's, $1,000, $2,000, maybe 2,000 is a little rich for you, but you're not going to have a $2 million tax bill every year. It becomes imperative that this year you need as much tax deduction as you can get. And so then you do, several of them, and you take the bonus on all of them. We had a client that had sold a business, and had a windfall of somewhere in the range of $20 million, right? What are you going to do?
Yeah.
I mean, you're going, okay, so I just got this, and now I got a $5 million bill. I need to write a check for 5 million. What can I do? And I'm not going to need it next year, right? The windfall
Right.
is a once in a lifetime opportunity. I
Right.
need the depreciation now. We have another client too that they inherited double E bonds, and so basically you don't need to know what those are, but basically you don't pay any taxes until they come due. And these
Okay.
bonds they inherited were like 50 years old. So every year they had an additional $120,000 coming due that was fully taxable, but it was only going to come due for another 4 years. So does depreciating over 39 years sound like the right way, or maybe accelerate that over a 4-year period sound like a good idea for you?
Right.
And that's, this is, I don't want to call it a game, but this is what we do with the IRS. The IRS is indifferent to tax timing. And that's why cost segregation doesn't necessarily raise your audit risk. is because if you are allowed by law to depreciate $1 million, and we keep that, and that's the one thing that we make sure we do, you don't depreciate a penny more or a penny less than $1 million. As long as you do that, they're more indifferent to when you do it. So because they're going, okay, you're going to take your $1 million early, well, then you won't get it late.
Right.
Right. And so that's why that's different than tax credits and tax deductions. You get a refundable tax credit. They are not only out money, but they may have to write you a check, like just straight out money.
Yeah.
And so they're going to verify that your tax credit is legitimate. With tax timing, I'm not saying, I don't want to be misconstrued that they don't look, but it's less of a priority to them because they're just going, well, it's a timing issue, and the IRS never really cares about timing. That's why they don't need to catch you. Like if you're cheating the IRS, they don't need to catch you this year. They'll
get you next year, the year after.
Yeah. And if we get you 7 years later, the penalties are going to be pretty bad. So they're not, they're not in a hurry. So time is not necessarily a matter, but what you can do is make that to your advantage. And that's, one of the secret sauce that we have is it kind of does come from me being a CFA, not a CPA. And again, I have the greatest respect for CPAs and what they do. We feel we're an expert in about 4 to 5 tax codes. There's 9,800 of them. So, this is no way denigrating what CPAs do, but it's just a difference of how I look at the world, right? So I'm looking at things from a financial standpoint and how to grow a business. And so what we try to do is we go, okay, so, not to call out anybody's age, but, we're decently young for property owners. I think a lot of property owners are, in their 50s and 60s. But if we had accelerated depreciation over 7 years, how many times do I have to repeat that before I retire? 2, 3, maybe?
Right.
Not a lot. And that's a tax timing thing. So I'm in my high income earning years where I want my highest depreciation, and I want to defer them to a time that I'm in a low income in retirement. Is one way of using timing to your advantage.
Sure. And so
that's one of the things we like to do.
Okay, that makes total sense. And so it sounds like if somebody is contemplating getting a cost segregation study done, it really needs to be kind of a 3-way conversation. 1 is themselves, the owner. 2 is with their CPA, their tax planner. And then 3rd is with a cost seg study to find out what the impact is going to be on their taxes. And then the CPA can tell them, hey, this is going to be beneficial to you now, or maybe you want to hold off. Is that fair to say?
I agree. Yeah, the CPA is going to be absolutely integral in the cost segregation. And I think one of the questions that, like we were talking about a little bit before, comes up is, well, why can't my CPA just do it?
Right.
And the answer is they don't employ engineers, right? They're not construction specialists, and that's we have kind of 3 parts to our business. I joke with people. I say, there's at least one part of my business that the eyes roll in the back of their head. It's like, oh, technology, that's super cool. Construction, love it. And you're like, taxes, you're like, oh, oh God, this is awful. Or you like taxes, you're like, dude, I'm a tax guy, man. I'm like, love the numbers and the tax cool. And you're like, sweet, go walk, do a bunch of construction. You're like, no,
thanks.
No, that's
rather not.
That's not really my thing, So it gives us a little protection for our business that somebody hates one part of what we do. So, but that just getting back to the CPA has their role, and they have to fit it into the overall picture, make sure all aspects of your tax life work, and cost segregation is going to work for you. We work very closely with a bunch of CPAs to, help them understand, exactly, just the ins and outs of a specific tax code, right? So, like I said, we try to be experts in about 4 or 5 codes, which, like I said, they have to cover 9,800. So I have insane respect for what they do. But when it comes to the 4 or 5, we can offer some help to the CPA and, and to the client to help them understand it a little bit.
Awesome. So when you did the cost segs for me, I had just done some major extensive rehab on a couple different properties. So I had heard that, cost segs are great for rehabbers, people that have done a lot of value add, people that have spent a lot of money on properties. But I had also heard that you could buy a turnkey property and still take advantage of a cost seg. Is that true?
Absolutely. Yeah, I think that when you dive into it, so let's just take look at them as two finished properties.
Okay.
Right. So if you have a multifamily or residential, you'd be looking at somewhere about 30 to 35% of it that we'd be able to allocate towards a faster schedule. So like kind of bonus side, right? So that's where you would kind of start. Now go to your rehab. You not only had all the remodel, but you had what we call disposal, or it's a partial disposal. So I'll explain it this way. If you bought a property for $1 million and you found out you had to put a roof on it, and the roof costs $100,000. So on your balance sheet, a lot of times people would put that their property is $1.1 million.
Mm-hmm.
But that's not true, because you don't have two roofs. You only have one. So you took a piece of property and you disposed of it. And whenever you dispose, when you have an asset that isn't worth anything anymore, then you have to take an immediate write-off for that asset. So let's say that the old roof was still worth about $40,000. What we would do is you would have all of the depreciation, just like a brand new place, plus anything you had to rip out and the cost involved with that in order to add to the cost segregation. So you got 30,000 to the cost segregation, but then you would add like the 40,000 for the roof you tore off, and all of the carpet and the toilets and whatever you pulled out of there, and that the stuff that you threw out would also add to the cost segregation. That's why a rehab is very, very good for you, but it doesn't take away from that. You could still get about 30% extra bonus write-off just from buying a turnkey place.
Wow. Okay. So is that kind of the ballpark estimate then? If I buy something turnkey, let's say I go buy $100,000 property, roughly I could expect 30,000 in bonus depreciation in year one, ballpark?
Depends what your land is.
Oh, sure.
Yeah.
Okay.
So we're talking building. Land is a big thing, and that's one thing that we can cover. And actually, one of the things that I think that we do a very good job of, and this actually, you're in San Diego?
Central Coast.
Central Coast. Okay. So there's actually a lawsuit that came out of LA County. There's a property owner that wanted to reduce the value of land that they were appraising in his building. And what came out of that lawsuit was that property owners do not have a specific ability to differentiate the value of the building versus the land. They do have an ability to value the total purchase, because that's what they do, right? They buy the entire thing. So it was ruled that the property owner was not able to do that. But that's where I come in, and we go back to what we were talking about with me having, construction audit certifications, being a valuation specialist, right? So I'm, one of 40 CFAs in the state of Arizona, right? And I'm, there's probably about 2,000 of us in the entire country, right? So do I hold the specific credentials to be able to value land versus building? I certainly do. And we use that. We will look at those and work very hard to make sure that your land is allocated correctly. And if it's not, we will provide the proof that it should be reallocated. An example that we would see, and sometimes they're accurate and sometimes they're not, right? But the example that we would see is, you have an allocation of land that we think is far too high. We will go and find land sales in that area over the last, 10 years. And we use pretty conservative numbers too. But let's say that they say the land's worth, it's $1 million building and they say the land's worth 400,000. We will go through and go, there hasn't been a piece of land sold in that area over a 10-year period over 100,000. And so we would just go, the actual sale of land is more accurate than whatever calculation you're using to assess that land. And so we would use statistical analysis. So, over 30 options, pulling out and reallocating, different, like your outliers, high and low, and use some very strong statistical analysis to revalue your land at, at a much lower level, if need be.
So Scott, this has been awesome, man. Thank you so much for coming on. If people want to get in touch with you, RCG, for your services, for cost segs, what's the best way for people to do that?
Yeah. So rcgvaluation.com that's where you run a quote. On that quote, you'll see somebody's name. His name is Tyler Baldwin. He is our director of sales. You can call him directly. And, if I have anything to say about it, he'll call you really, really quickly. we work on that very hard. I also, I think, Michael, you obviously you've worked with us and you can attest to this. Once you start working with us, you will have my cell phone. You can just call me. Yep. So, and I try to answer, and we try to be as available as possible. So we like to get out, get our quotes and get to people as quickly as we can, and help them save some taxes.
Love it. Scott Roelofs, thanks so much, man. Really appreciate you coming on.
Oh, yeah, dude.
Awesome, man. Well, take care. And I'm sure I'll be calling you for my next cost seg study shortly.
I appreciate it.
Yeah, totally.
We love it.